Alrighty, so today's episode is another topical episode. So, like I said, whenever I feel like doing these for topics of the week and not just educational purposes. Well, this is for educational purposes, but education on instead of like accounts and things like that. We'll talk about more about news and things I find interesting in the markets and stuff that can help you discern and dissect. That way, you're not dependent on someone else's information. You can kind of ask these questions and gain this understanding yourself. So today was a Apple event, and it was a very important Apple event because they did they announced a new headset. They call it the Vision Pro. And I guess it's like using VR and AR, so virtual reality mixed with some augmented reality type things together, and it makes it looks cool. $3,500 I think. And I just realized I am doing a video, so this is going to be the first video on my YouTube that is an actual video and not just a voiceover. So let's take a look, shall we? So we got an Apple announcement. So a lot of people ask me all the time, the wise investor, hey, Apple just released this, or this company just doing this, and it's like it popped like Nvidia not too long ago. Should I get in it? Well, like I think this week's episode that comes out, I think it's this week's episode, maybe next week's episode. I talk about asking questions and being patient. So everyone knows the saying. And when you're investing, buy low, sell high. A lot of people, myself included, at times buy high and then sell low. And that's how you invest backwards. So Apple hit a all-time high, not a 52-week high. If you're wondering, like, what is a 52-week high? Basically, in the last 52 weeks, the high that the price has ever been. Now, a all-time high is different. That means this is how high stock has ever been since IPO, and that is important because not too many stocks, especially like tech stocks and growth companies, are hitting these all-time highs. Now, there are some companies in the S&P or in the market may hit an all-time high, but I'm talking about the blue chips. The big boys, and now a lot of them are hitting all-time highs over the last year or two. So for Apple being a tech company, a growth company, and has been chugging along, basically beating the S&P 500 at this point, that's a really fantastic feat that not a lot of companies can do. Apple is one of the best companies in the world. I know everyone and their mom is going to say, well, I told you so. Everyone and their mom are going to tell you that, you listen to me. I told you. Apple, well, everyone knows Apple is the best company in the world. There's nothing new under the sun. But the cautionary tale is, yes, Apple is a great company, a $1 trillion company. One of the best companies in the world. But is it time to buy right now? And, I might throw in this chart here. Hopefully I can, in post edit, throw in this chart of Apple. But that means I would need to record my screen. Give me 1 second. So if we pull up a Apple chart, which I'm about to do right now, we'll see the analogy that I talked about, buying low, selling high. You'll see like, hey, Apple is at an all-time high. Is now the time to purchase it? Let's see here. Let's go to this and let's make this one, and let's go on let's do a weekly chart. I like that. Alrighty. So, let me record this. So as you can see here, cut off the narration. We don't need that. So as you can see here, this Apple chart, voila. We hit a all-time high here. I really don't like talking about equities too much because they are securities. So I'm not endorsing buying Apple. I'm not endorsing not buying Apple. I'm not endorsing selling your Apple shares if you are Apple shareholder. I am just providing some information to give you a better idea of what you should decide to do with your finances by asking questions and just using a little common sense on, buy low, sell high. So as you can see here, this is a weekly candle. Each candlestick represents 1 week of price action. And these are the highs from 2021 through 2022. You can see, you had some dips going down until it hit a low in December or in January of this year at 124, around there, 125. And then we just went to the moon, as the kids would say, and took out this high. So for those who are listening, basically what happened is, like I said, the price went down to around 125 and now is back up to around 180. I think the high now is 184.95. So that's the highest. So that's a pretty significant movement. And the listeners on Spotify, Apple Music, wherever you are listening to this podcast, we've pretty much only had about 4 weeks of down closing candles. And one of those weeks was really an indecisive week, meaning that out of 1, 2, 3, 4, 5, 6, let me do that again. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. So out of around 22 weeks, we've been going almost vertical, straight up. And out of those 20 some odd weeks, only, like I said, 4 have been down closing or, negative. And one of them is slightly negative. So that's a lot of movement, a lot of money just pushing this stock upward. And it's important to, not get FOMO, not get, oh no, I'm going to miss out. Because if you believe in Apple, you're not just listening to, whatever guru says, whatever. If you are actually paying attention to, their earnings, their products, their innovation and all that good stuff, then you should know, like, hey, I know from my research and maybe my money manager or my advisor's research that this company is a great company. I want to keep buying it. So if you know that, well, then technically it doesn't matter where you buy that because you're going to be a holder. But you want to be a little bit more cognizant of, buying at the highs. And one of the reasons being is, yeah, you might hold it for a long period of time, but that drawdown is going to hurt. And what a drawdown is, for some of the listeners who don't know what a drawdown is when, you're having unrealized losses. So a realized loss is when you actually sell the equity or the stock. And unrealized loss is you are holding it, you haven't sold it, you bought it, you haven't sold it, but the price, the value is still going down. That's a drawdown. So if you buy these highs now and we start to retrace back downward, you're going to be in a drawdown, and that's going to not feel good. And a lot of times people don't understand investing is a very, very emotional endeavor. Like your emotions, is really important when it comes down to investing. And you don't want to, be upset, disgruntled when you're seeing if you get in drawdown. That's if, Apple goes into a drawdown. So that's just my piece of advice for, you know, Apple. Apple is a great company. They have a lot of cool things happening at the moment. Me personally, I'm not an Apple person. I love the company, but I have an Android. I've been in the Samsung ecosystem for a very long time, and it's hard to switch over once I'm in that ecosystem. In which a lot of these companies, that's what they do. So yes, I would love to get the Apple goggles or the VR set. But that means I would need a Mac. That means I would need an iPhone, an iWatch, Apple AirPods and all that stuff. And that's just too much. But I definitely want to go to the Apple Store to test them out when they come out. I believe it's early 2024 is the announcement. But this is one of their first major releases in a long time, over I think nine years or so. I do like Apple, but not only Apple. Actually, let me turn this back on. Not only Apple. I want to also talk about one of the things that I do. So as you guys know, I am a investor, or a money manager, or I'm a financial advisor, money manager, investor, etc. But I also I trade. I don't trade often like I used to. Like, I trade a lot, but not as like I used to. Because real life kicks in. But I do trade futures. And one of the future commodities that I trade is the micro contracts. And they're not securities; they're considered commodities. So that's a whole nother thing. And if for those who don't know what a commodity is essentially, I think of like cotton, lumber, sugar, wheat, those type of things that, you hear about, oh, the price of eggs is going up. Well, that's a commodity. So, and the index futures, are considered commodities. But I like to trade the S&P 500 not ETF, future index. I use the MES, and what I'm going to show is basically just my, I guess analysis. And for those who are listening, I'm going to do my very best to be as descriptive as possible, as humanly possible. That way you can still get some benefits from this podcast. So we're going to go to the forward contract. Let me erase all this stuff. All right, so this is a weekly chart of the micro E-mini S&P 500 index futures. And as you can see, like I said last week, that I felt like we only had like maybe a half or 1.5% to 2% before we take a small cool off. That's my personal analysis that I've done from my research. So I'm not saying that this is advice to do anything. Please don't do anything off of things I say, because I do not give advice over the internet, and etc. But I believe, I don't know, I think it was around here. So let's go up to the highs. So if you look at the highs, so I'm pointing out where I marked off last week. I'm not 100% correct, but I think it was around 42.15, 42.20, 4,200, or in that ballpark. I was saying that it looks like we do want to come back up a little bit and not go up that much higher, and that seems like what we're doing. Like we spiked up from last week to this week about 1.5% to 2%. And now we might take a little breather, because the market has done a lot. And I'm not saying, buy puts, short the market. No, I'm saying that we might have a little breather. And when we have a little breather, we're going into typically a seasonality that is bullish, but also the seasonalities have been a little wishy-washy or flip-sided. I think usually around February, March, and all that stuff, we dip pretty hard. Usually in May we sell off, and then we start coming back up. But the market has been doing the opposite of a lot of things. So I can definitely see something like that playing out for the next quarter until we get to September. But we'll see. I don't know. But so I do feel like if you're looking at this chart here on YouTube, we could definitely just retrace. The market always retraces. It always goes to a mean. Revert back to the mean. If you don't know what that means, it's essentially just go back to where it came from. Essentially, retest is a lot of times what they call it. So for as that's pretty much my analysis on that. I think we're gonna, just fall back a little bit. We did a lot over the last, few weeks. Even this little dip we had 3 weeks of negative price. So that's a lot. So now that we got that out of the way, the next thing I want to talk about is what to do from here. What questions should you ask? So if you're, since I'm on YouTube now, I guess I'm a YouTube finance person now, and you might hear a lot of people ranting and raving over the gains they got over the last couple of weeks. A lot of times they're going to do victory laps around the interwebs. They're going to do victory laps on YouTube, Twitter, Instagram, to help build their brands, to help build their fan base, to help, their prices go up when they sell courses. And a lot of times that give a lot of people FOMO. They give them a little anxiety. But keep in mind, like I said, your financial journey is a personal one. You shouldn't allow other people control your hard-earned money. And what I mean by let other people control it, meaning if I say, hey, do this, and you do this because I said so, and I'm just some guy on the internet, that's not very wise when it comes down to money management. Because my risk tolerance, your risk tolerance, that person's risk tolerance, even our situations, everyone's completely different. So I cannot, if you're listening to someone suggest, hey, everyone should just do this blanket portfolio allocation, then how do you know that's what's suitable for you? Like, Apple, everyone's going to want Apple. Apple is a nice thing to have in a lot of portfolios. But like I said, Apple is a growth company and it's going to retrace, and it may retrace harder than some companies who are not considered growth companies. And if you're an older individual, and you're, depending on a lot of this stuff for retirement and, bills and whatnot, can you handle that kind of emotional distress when you start seeing your account go down, especially if you got FOMO and started buying at the highs. So that's something you really want to ask yourself and the person who's suggesting things to you, even if it's your money manager or financial advisor. I tell people all the time, ask me questions. My job as a financial advisor is to advise. I can't, advise you if you don't ask me questions. Like if you think about advisors to world leaders, kings and all that stuff, they ask their advisors questions. Hey, is this a good idea? And then the advisor would give their advice. And that's what I do. And that's what a lot of advisors do, is give their advice. And we can't give it if we don't know the questions. So ask. And if you're listening, if you're getting your advice from YouTube, which don't recommend, and you have someone telling you what to do, well, ask them questions, because at that point they're acting like your advisor. If they're acting like your advisor, then ask them some questions. And if they don't have the answers, or they get upset and they're like, don't ask me questions, then they're not your advisor and you shouldn't be taking advice from them. It's plain and simple. So even if it's, people are going to say, do your due diligence, but listen to me. And that's, don't correlate at all. How can I do my due diligence when you're telling me to only listen to you, but in my due diligence, I have to ask questions to other people, get other people advice, do my own research, but you're saying only listen to you. That don't add up. And usually that's because they're trying to protect themselves. And my job as the wise investor is to help you guys make wiser decisions. I'm not trying to be your money manager. I'm not trying to be your financial advisor. I'm just trying to impart wisdom to make, the listeners, the viewers, make wise decisions. So I'm looking on, a news website to see what else. The stock futures went lower. Well, I think I explained that why. People think that I sell the news. Well, we're pretty high up there. Like, you're talking about all-time highs on Apple. You're talking about the S&P 500 being at levels that it hasn't been in over or a little under a year, since August 2020. So you're talking about levels that are pretty, like I said before, a little overbought. So of course there's going to be a pullback. And I'm looking forward to the Fed meeting. That's another thing. Because the Fed meeting, they're gonna announce, if they're gonna raise rates or if they're gonna pause. And I'm in the camp of, pausing. But even if they paused, one of the things that a lot of people don't seem to understand is the rates are still going to be high. So yes, they will pause the rates. There's no more rate hikes, but we're still going to be in a high interest rate environment. I'm not getting excited until we start cutting. And even when we start cutting rates, we're still going to be in a high interest rate environment. Unlike, years prior where, the interest rate were really, really low. So that means borrowing money, credit, all that stuff is still going to be expensive. And if you're talking about growth companies, tech companies who rely heavily on debt, essentially, loans and all that stuff, you're talking about a higher spending still for who knows when. So until the Feds give us a game plan of like, hey, we're going to pause rates for the next 2 quarters to see, what's up with inflation and all that good stuff, and then we'll, potentially start to think about cutting, then, but until, if they just pause without giving no other guidance, that's still uncertainty, because, you're just going to hold us in a stranglehold until what happens. But I still like bonds, and I definitely like bonds if we pause, because that means you'll be able to get more yield a lot longer for not only bonds but savings accounts. Like there's a bunch of high yielding savings accounts right now, CDs. A lot of banks are offering high yielding CDs. And if you are a person like, okay, I'm going to use myself for example. If I were to have money in something and I go and be like, okay, this has been a great run, let me shave off some profits, not all thing, because I'm a long-term investor, but shave off a little bit, take a little bit of profit, I'm going to put that profit into something that's going to be yielding safely, like a money market account, or like I said, a treasury bond, or a CD, something that especially if it's money I don't need right away, it's just some profit. I'm gonna lock it up somewhere that's gonna earn me some yield. And I know that doesn't sound sexy. That doesn't sound like 20-30%. That don't sound like 150%, but it's safe. And I'm getting older. I turned 30 this month, and safety is something that I am seriously thinking about, because I can't, my working years is getting close to being done. I'm not 20 no more. I'm not 15. I've been working for a long time, and that's one of the things you should think about with your situation is, how many more working years do I got? Can I afford, if this stock, wherever I got my money into, if it were to drop 40%, what would happen to me essentially? It drops 40% and something happened at work, and I'm disabled now, or things like that. Can I make that money back, especially if I sell? So that's a question you should think about when you are, taking advice. How many more working years I got left? Is this something good that's going to help provide longevity? As I get older, if I have kids, for my kids, if I have family, for my family. And bonds is, fixed income is one of those avenues that I view as a safety net. Because some people will say, put all your money into a few equity assets, and that's great and all. Well, depends. Sure, you want to listen to that, go by all means. But where's your safety net? A lot of times they use the indexes as their safety net. But as we've seen in like 2020 and 08, and even in 22, the indexes can still fall a lot, about 30%. It can enter bear markets. So if you got your equity, let's say you got all your money into growth equity, and you got the other all your money into indexes, and the market just falls apart, the actual index falls 30% and the actual stocks fall 50%. That's a lot of loss. And of course it's going to recover, but what if something happens? We live in uncertain times, and uncertainty is all around us. It took almost a year for the market to not even fully recover to where it's at now. If something happened in between a year, like a baby or an illness, or an unexpected expense, your car broke down, your house flooded, you need a new washer and dryer, you lost your job, or they cut your hours. Can you handle that while you're in a 50% drawdown? And especially at whatever age you are at this moment. And that's one of the things I ask myself, and I tell my clients to ask themselves, can you handle this? And though bonds and fixed income are, considered old person's, game, but right now the yields are really high. It makes no sense to just allow yields like that not to be utilized, especially if you have profits, and especially if you have the extra income that you're not using nothing for, not doing nothing with. Why not have a mix of them? A diverse portfolio. And diversity doesn't mean everything is in equities, but you have different companies. Diversity means, different assets, different asset classes, different types of assets mixing together in a portfolio to create a diverse portfolio. So if you have, a equity portfolio that's indexed in growth companies, that's not 100% diverse. That's not really diverse. Now, yes, you have the index, but you're still exposed to the equity side of risk, which, we experienced over the last 3 years, from 2020 to now. So just, something to keep in mind as you go about your day. And I really hope I gave some insight, some wisdom on these topics. I still like the bonds. I can't wait to hear what the Fed says. Just a quick overview. We talked about Apple, great company, A+ on that presentation. I'm looking forward to the Vision Pro. I'm also looking forward to a pullback on the equity market, so we can find some deals. As advisors and as investors, we love some deals, and ask questions. Definitely ask questions no matter who they are. And if you're not talking to them personally, ask questions to yourself and then do some reasoning with yourself. And, don't be afraid to combat or challenge someone when they're asking you to put up your hard-earned money that you work for. So that's going to be it, guys. I hope this was an enlightening episode of the WealthWise shows for you. I hope I imparted some sort of wisdom, even if it's just a smidgen of wisdom. I hope I imparted it to you. Like always, thank you for listening. And, guys, this has been a really nice, this is probably going to be the third episode that you guys are going to hear, but I've already, recorded a few episodes. So this has been a really wonderful journey. I appreciate all the listeners, all the followers. Don't forget to subscribe to my channel, my YouTube channel, Spotify, Apple Music, Amazon Music, iHeart app, all that stuff. Wherever you listen to podcasts, subscribe, like, comment. I will greatly appreciate it. And until next time, guys. Stay WealthWise.